The most dangerous moment in trading isn't fear. It's the day you feel unstoppable. The day you look at your account, lean back, and think, "I've finally figured this out." Because that feeling? It's not a signal that you've mastered the market. It's a warning light. And almost nobody recognizes it until the damage is already done. There's a psychological curve that explains this perfectly. It's called the Dunning-Kruger effect. And when you map it onto a trader's equity chart, something chilling appears. The two curves line up almost perfectly. Your peak confidence and your biggest risk of blowing up happen at exactly the same moment. Let me show you how. Dunning-Kruger describes a simple, brutal pattern. When you know very little about something, you have no idea how much you don't know. So your confidence rockets up fast. A little bit of knowledge feels like a lot. You learn a few candlestick patterns, you catch a couple of good moves, and suddenly the whole game feels obvious. Researchers call the top of this curve the peak of Mount Stupid. It's not an insult. It's a stage. And every single trader passes through it. Now watch what happens when a beginner opens their first account. The early trades are small. The stakes feel low. There's a healthy nervousness in every click. And then, the market gives them a gift. A few winning trades in a row. Maybe a lucky momentum run in a strong bull phase where almost everything goes up. Here's the trap. The beginner doesn't credit the market. They credit themselves. Every win becomes proof of skill, when a lot of it was simply favorable conditions. This is a bias called self-attribution. Wins are my genius. Losses are bad luck. And it quietly rewrites the story of how you're actually performing. So confidence climbs. And with confidence comes the single most dangerous decision a trader can make, increasing size at exactly the wrong time. Think about it. When you started, you risked 1% per trade. Now you're up 30%, you feel sharp, so you bump it to 5. Then 10. Why not? You're winning. This is the exact overlap. Your confidence peaks. Your position sizes balloon. And your account has never been more exposed to a single bad move. Now here's the part almost no one talks about. The market didn't change. You did. The same strategy that made you money is now sitting on triple the risk. So the next losing streak, and there's always a next losing streak, doesn't just dent your account. It detonates it. One oversized position wipes out weeks of gains. And the cruel timing is this. The blow-up happens right after your best stretch. You felt like a genius on Monday and margin called by Friday. This is why blow-ups aren't random. They're structural. They live at the top of the confidence curve, and they hit people who did well recently, not people who did badly. Let's be clear about something. This isn't a character flaw. You're not stupid or reckless for feeling confident after winning. Your brain is doing exactly what brains do. Recent success literally floods you with reward chemistry. It lowers your perception of risk and raises your sense of control. Overconfidence is a predictable stage, not a personality defect. And that reframe matters. Because if overconfidence is a stage, then it's something you can anticipate. You can build guardrails for a version of yourself you haven't met yet. So what does the curve do after the crash? It drops, hard. This is the valley of despair. The trader who felt invincible now feels like a complete fraud. And ironically, this is the most honest they've been. This is the moment real learning begins, because now they finally see how much they didn't know. The trader who survives long enough climbs the far side of the curve. Their confidence returns, but it's a different kind. Quieter. Backed by scars instead of luck. Here's the tell that separates the two. The beginner's confidence grows when they win. The professional's confidence comes from following their process, win or lose. So how do you protect yourself on the dangerous peak? First, fix your position size in advance, and refuse to raise it just because you're winning. Winning streaks are exactly when your risk rules should feel too small and boring. That boredom is the sound of your account surviving your own confidence. Second, keep a record. Not just of trades, but of how you felt. When you catch yourself thinking you've cracked the code, that's the moment to shrink, not grow. Because the market has a dark sense of humor. It hands out the most confidence right before it collects the biggest tuition. So the next time you feel unstoppable, don't celebrate. Get suspicious. That feeling isn't your reward for winning. It's the setup for the loss that teaches you everything.